Thank you everybody for attending this presentation and welcome to Payment Cards in Your Business. In this presentation, we will be covering some benefits of credit cards, how the technology works for you, how to negotiate rates and fees, and how to stay secure. As we move along, we're going to get into the benefits of accepting credit cards. And first and foremost, it actually in this day and age legitimizes your business. It improves a merchant's cash flow. It actually improves through impulse purchases. It adds convenience to the purchaser. It makes for larger orders, has an added level of security because they don't have to carry cash. And obviously, since the competition is doing, you got to keep up with the competition. Over 90% of web purchases are made using credit cards instead of debit cards. Getting into a little bit of card technology. The electronic payment networks known as EPNs, like MasterCard, do the following. They connect businesses, customers, and banks instantly and securely. They also build and make available fraud and security tools to secure the merchant and the transaction. So not only have they built the rails in which the electronic payment systems work, they've actually brought and built security tools to better the transactions and the industry. Here we're going to take a look at what we call the arc of innovation, where we were, where we are, and where we're headed. So in the very beginning of time, we look at the carbon copies and the raised numbers. We moved along to the magnetic stripes that contain all the card data for transactions, with CVV code CVC, holograms, and other security features for in-person and remote security. Moving from there, we got into the contactless payment worlds with RFID technology known as radio frequency ID, where you can tap and go without ever having to put your card in anybody else's hands. A key fob or a sticker you can place on a cell phone, etc., was also part of that technology. In this particular situation, we're going to look at some key security features: holograms, CVCs, embossed numbers, etc. You'll see that illustrated on any bank cards. On the right-hand side, you're going to see a debit card. This is going to show you a technology that's been effective in Europe and around the world for many years, is now being introduced and launched in the US. It's known as EMV technology, and we're going to get into this very shortly. PayPass is an embedded radio frequency chip and antenna to MasterCards or any contactless devices. With MasterCard PayPass, consumers can speed through checkouts with a very simple tap rather than a swipe or a dip of their credit card. When combined with the MasterCard program known as QPS, Quick Payment Service, no signature is necessary for any purchases under $25. So literally, consumers can just tap and go. Advanced chip-based cryptography, known as CVC3, even stronger than CVV2, delivers another layer of security to make this fast and convenient payment a very safe option. Moving on, we're going to get into the EMV and chip cards now. EMV is a global standard for credit and debit payment cards based on chip card technology. So where did it come from? Well, it takes the name from card schemes such as Europay, MasterCard, and Visa, developed by the three of them. The standard covers the processing of credit and debit card payments using a card that contains a microprocessor chip at the payment terminal. Payment cards containing chips are much more powerful than traditional magnetic stripe cards because they contain tiny computers that make transactions safer. Chip technology also reduces the incidence of fraud by making cards more difficult to counterfeit. Although chip technology is widely used in some areas of the world, it is still an emerging market here in the United States. With these innovations, merchants can rest assured that their best interests are being addressed while minimizing the possibility of fraud. There is a ready supply of payment processors who want to compete for your business. The challenge is that costs can vary among processors, and some business owners find it harder to get apple-to-apples comparison between them. Understanding who is competing for your business helps you to compete. It levels the playing field. Here we're going to look at some processor groups and how they are associated. You still must compare pricing, contracts, additional fees, and the value add and service offerings before you make any decisions. Any one of these providers could become your processing partner when and only when the relationship clicks. You have options. There's a lot of swirling competition and conflicting information out there about and among these groups. We want to provide an overview that can help you make sense of all of it. Acquiring banks are local, community and regional or national banks that participate in the electronic payment networks, the EPNs, on the merchant side of processing consumer payments. Just as consumers have checking and savings accounts with each group, so do the businesses. A direct electronic payment processing account through one of these banks, including your local bank, has many advantages if you already have a broad banking relationship. Some banks have an in-house payment processing resource, and others may outsource those processing services to a TPP, known as third-party processor. So what is a third-party processor? They focus primarily on larger merchants. They can be more cost-effective and flexible for larger businesses because the processors have direct access to the EPNs, the electronic payment networks, through an acquiring bank relationship and provide all the support on large business accounts. These TPPs don't have consumer brands the general public would recognize easily, as they function exclusively in a business-to-business environment between businesses and acquiring banks. Another level are known as ISOs and MSPs, independent sales organizations, and merchant service providers, and these terms are used interchangeably. These organizations specialize in soliciting smaller business accounts and then contracting with the acquiring banks or TPPs to provide the actual processing services. They are one step removed from the electronic payment network. ISOs and MSPs may specialize in a specific business sector, making it easy to get a merchant account from someone who knows your field of business. ISOs and MSPs' costs can be higher than other options, as they have to pay a transaction fee to the acquiring bank or TPP in which they partner to deliver your services. Internet payment service providers work with TPPs or acquiring banks to provide payment services to you. They focus on small or medium-sized internet businesses, usually providing technical support on proprietary payment platforms. The cost of specialized services, TPPs' fees and acquiring bank fees add to the overhead of your costs. What you really need to do to better have an understanding of the industry is better understand your provider. So ask questions, find out how they work, how they think, how they mitigate risk. You need to understand what the boarding process is, what the risk department process is, how they fight chargebacks. Super important to understand how your processor functions. This way you can work with them in a very effective manner to grow together. Here we're going to go over some steps to a successful relationship, and there are 6 key steps. Step 1. You want to understand the fees and the MPA, known as the Merchant Processing Agreement. Your fees are going to include things like fixed fees, transaction fees, rates, your monthly service fees, statement fees, early cancellation fees, setup fees, downgrade fees, any and all fees, dues, and assessments that they could put on that merchant service agreement. You should understand and know why they're there and why their costs are what they are. So, second one would be equipment. You need to get the right equipment for your right type of business. If you're retail, you're going to need a specific piece of hardware. If you're moto or e-commerce, you're going to use a gateway. You can also use a terminal to key in transactions if you decide to do so. Mobile commerce can be used through a terminal, which could do 2 functions. It can be used as a terminal to transmit that data live, or a function known as store and forward. The good thing about mobile commerce, because you have a terminal in hand, these are all retail transactions and they are inexpensive. Number 3, think customer service. You being the customer. You need to ask a few good questions, and you have to be satisfied with the answers that you receive. Here's a couple. Can you help me run a test transaction so I'm familiar with the way my system should function? And test transactions could be debits, credits, adjustments, what have you. What do I do in case my primary processing system fails, my terminal, my gateway? Do I have a backup? What are the options? How else do I process my payments through your organization? Do you have 24/7 support? If so, how do I contact them? More importantly, within not only how do I contact them with the support level, is do you have to open a ticket and wait for a response, for a call back or response? Are your needs taken care of at that moment? If you have a challenge with your terminal, your gateway, what have you, you need your answers right away. You need somebody that'll be able to assist you immediately, not an hour, 6 hours later. That's super important. Who will be my point of contact for any questions that I may have? And then you must qualify that individual. Are they knowledgeable? Do they understand my business model? If they give you rates, specific rates, here's your qualified rate, here's your transaction fee, and then all of a sudden you start to see hidden or junk fees, as we call them. They may appear minuscule, half a penny here, 9/10 of a penny there, but in the long run, believe me, they add up, and the price that you thought you were paying is much less than what you'll actually be paying. Obviously, misleading advertisements can lead the merchant to signing agreements which are very harmful. So if you see something that doesn't make sense or an offer that's too good to be true, you're right, it's too good to be true. So let's look at asking some questions. When you get involved with a provider, some of the questions you want to ask, additional to the earlier ones, how is your customer service structured? If I decide to sign up a merchant account with you, the startup time takes how long? Equipment, sales, and support. Do you buy terminals from the provider? Do they lease? Do they rent? Do you have to get your own? What is the underwriting process? The underwriting process should be clean and easy. Up front, you should understand what your provider needs from you. So they're going to ask you for the articles of incorporation, a driver's license, a voided check, possibly financials, audited financials, personals, a corporate guarantee or a personal guarantee, merchant processing statements if you've had them, if your business has been around. But you should have the majority of those details up front. If in case another communication or two need to come down the pipe, it should be for extenuating circumstances, for additional information, not the norm. Again, the needed documentation. When they send you out what you need for your merchant account, obviously get it in writing and understand why you need these documents. What is their risk assessment and their focus? How are they going to assess the risk on your account? What are they going to be looking at? Are they going to be looking at what you sell to whom and how? Are they going to look at your prior record of your merchant account? You've had chargebacks, reversals, the account is in good standing. Are they looking at credit score? Are they looking at all the above? You need to find out what they're looking for and how they're going to assess it. What is their support? How do they support you in fighting chargebacks? So you have chargebacks coming through. What does this processor do to help you fight the chargeback? Do they guide you through a chargeback rebuttal process? Do they tell you what you need to get to fight the chargeback? Also, when you make transactions and you get paid, when do you get paid? When do your funds settle? 24 hours later, 48 hours later, 72 hours later? Is there a delay and why? Who is the sponsoring bank of this current provider? Is it a known name? Is it a bank that you can trust? Is it someone that you'd be comfortable doing business with? Or is it a bank that you've had a hard time doing business with elsewhere? The payment card industry program. Who is the provider for PCI for your merchant service provider? What is the support they offer? Do they guide you through the program? Do they help you understand the requirements? And do they help you understand what you need to do to be and stay PCI compliant? Very important. In this particular case, we're going to look at a little bit of security, but it's a very, very simple mantra. Keep up with the security practices and tools, logical and physical security. Do not let it lapse. That's it. That's as simple as it gets. You need to stay in tune with the latest and greatest tools in security for transactions, for physical security, for logical security, for your IT. So obviously, truncated receipts, the latest terminals which are compliant. You know, what you do with your receipts. You got to be truncated. You don't leave them out in the open, you lock them away. Who has access to what? So there's a hierarchy there as well. We're about to be vigilant in what we do. You need to check your merchant statement monthly. I know some people do it quarterly or semi-annually or annually. It's not enough. You need to see what your statement is and compare them against your last statement. If you've processed the same amount of dollars month after month or close to it, if your dollars to the processor varies considerably, you need to see what happened. Investigate and question any discrepancies, from the slightest to the largest. If you see an additional fee that doesn't make sense, that wasn't there last month. If you see a transaction rate went up, your rate went up, something changed, something that wasn't exactly what it turned out to be earlier is now on the statement, you need to investigate that. Again, here we go with communication. Keep in contact with your provider. Any changes to your business must be conveyed to your merchant service provider. They need to know if you've changed your business model, your price structure, your method of delivery, whether you've gone from retail to e-commerce to Moto. You need to tell them that because that will flag the system. And every processor has an internal system. If your transaction size changes, if your average ticket is $100, your high ticket is $500, all of a sudden you have a sale for $1,000. Of course, do not turn the sale away. Contact your processor and tell them, I'm putting a sale through for $1,000. What do you need from me? You need the invoice, you need this, you need that. You need to communicate. And of course, monitor your chargebacks and your retrievals. Very important. Here's the PCI piece. Any entity handling payment cards can work to achieve PCI compliance with the PCI Data Security Standard using MasterCard's Site Data Protection Program. This program applies to merchants and service providers that process, transmit, or store cardholder data. Through the network scanning requirement, MasterCard's Site Data Protection Program is also designed to protect against the compromise of account data. That's enormous. Remember that your acquirer, your service provider, will be closely monitoring your PCI compliance regarding the PCI Data Security Standard. What is PCI? It's been brought about for the protection of all who participate in accepting and transmitting credit card information. Sensitive and critical data need to be secure for best practices, and it also drastically minimizes the risk for compromise to you and your customers. It's another must-have. A data or credit card breach can cost you more than you make and therefore could drastically hurt you and your business, and the fines are very expensive. It is a proactive measure that should not be overlooked. Signing up for PCI and being compliant only helps you and your business and can be the difference between losing everything you've built or a long and viable relationship. At this juncture, we're talking about education and training, and we can all use more education and training, especially in this field. There are other more intensive training and learning opportunities that include MasterCard's Global Risk Management Conference Series, which is one of the world's leading security conferences in the payments industry, and also ARM training. These are courses that have been designed to provide the necessary skills and knowledge to improve risk management. Thank you very much.